Hi and everyone, welcome to my YouTube channel which is explore yourselves, banking and general knowledge etc. Today I am going to talk about balance sheet analysis. Balance sheet is a simple financial statement that shows a company's financial position at a specific date. It tells us what the company owns, assets, what is owed, liabilities, and how much truly belongs to the owners, equity. This statement helps us understand the stability, strength, and overall health of a business in a clear and structured way. By reading a balance sheet, we can quickly see whether a company is financially strong, balanced, or under pressure. Think of it like your own personal situation. Your bike, phone, laptop, money in wallet is equal to assets. Your pending EMI, loans from friends, that is liabilities. Whatever remains after paying all dues, that is your net worth, equity. Formula always works. Assets is equal to liabilities plus equity. If this doesn't match, something is wrong. Three big parts of a balance sheet. Number one, assets. What the company owns. That is two types. First type is current assets. These are things that turn into cash within 1 year. Examples: cash in hand, money in bank, stock or inventory, bills receivables, customers who will pay soon, and short-term investment. Easy example: if you run a small shop, your current assets are cash rupees 10,000, stock rupees 50,000, customer dues rupees 20,000. That's total rupees 80,000. And non-current fixed assets, that is long-term things used for many years. These examples: land, building, machinery, computer equipment, and furniture. Easy example: your shop's fridge, shelves, and building. Number two, liability. What the company owns. That is two types. One, current liabilities, dues that must be paid within 1 year. Examples: supplier payments, short-term loans, electricity bill pending, salary payable, and tax payable. Easy example: you bought stock worth rupees 40,000 from a supplier and have not paid yet. That is current liability. Non-current liability is long-term loans. With examples: bank loan for 5 years, debentures, the long-term lease payments. Easy example: you took a loan of rupees 2 lakh for buying shop furniture. That is non-current liability. Number 3, equity. What the business actually owns after paying all dues. Formula: equity is equal to total assets minus total liabilities, which includes capital invested, profit retained, and reserves. Easy example: you invested rupees 1 lakh to start up the shop. That is equity. If business earns profits, equity goes up. If business suffers loss, equity goes down. How to analyze the balance sheet? Simple and practical way. Here is the real value, understanding whether a company is healthy. Number one, check liquidity, short-term strength. Ask, can the business pay its short-term dues comfortably? Current ratio, that is current ratio divided by current liabilities. If above 1.5, then it is good. If it is below 1, danger. Company may struggle to pay dues. Examples: current assets is rupees 80,000, Current liabilities is rupees 40,000. Current ratio is 2, so it is good. Check gearing or debt level. How much debt is used? Debt to equity ratio is equal to total debt divided by equity. If it is less than 1, then safe. If it is more than 2, then risky. Example, debt is rupees 4 lakh, equity is rupees 2 lakh. So debt to equity is 2, then it is high risk. Part 3. Check asset quality. Ask, are assets real and useful or just lying idle? Examples, old machinery losing value, inventory stuck for months, customers delaying payments for 6 months. If assets are not productive, business is weak. Number 4. Check reserves and retained earnings. A strong company keeps some profit for future. If reserves are growing, good management. If reserves shrinking every year, warning sign. Number 5. Check working capital. Working capital is equal to current assets minus current liabilities. Positive is equal to comfortable. Negative is equal to high risk. Examples, current assets is rupees 80,000, current liabilities is rupees 40,000. So working capital is rupees 40,000, then it is good. Number 6. Compare year on year. Don't analyze only 1 year. Look at least past 3 to 5 years. Check if assets growing, liabilities controlled, equity increase, reserves increasing, debt decreasing. This shows the trend. 7. Common red flags to watch. Too much short-term debt, inventory rising but sales not rising, customers taking too long to pay, borrowings increasing every year, reserves decreasing, negative working capital. If you see 3 to 4 of these, company is in trouble. Easy example of a mini balance sheet. ABC Traders balance sheet. Short example. Assets. Cash rupees 10,000. Stock rupees 40,000. Customers due rupees 20,000. Furniture rupees 30,000. So total assets is rupees 1 lakh. Liabilities. Suppliers due rupees 25,000. Loan rupees 35,000. So total liabilities is rupees 60,000. So equity is 1 lakh minus 60,000. This is rupees 40,000. Analysis. Current assets 70,000. Current liabilities 25,000. So current ratio is 70,000 by 25,000 is equal to 2.8. Then it is very good. Debt divided by equity is equal to 35,000 by 40,000 is equal to 0.87. So it is good. Company is in financially healthy. Conclusion. When you look at a balance sheet, we basically try to understand the financial health of a business at one specific point in time, just like checking someone's medical report for that day. By studying assets, liabilities, and owner's equity, we can see what the company owns, what it owes, and how much truly belongs to the owners. This helps us judge if the business is stable, safe, and capable of handling future challenges. Simple examples like comparing assets to liabilities or checking whether the company has enough cash or depends too much on loans make it easier to understand how strong or weak a company really is. Balance sheet analysis does not need complex words. When broken down step by step, it clearly shows the company's overall financial strength, its ability to pay bills, and whether it is growing in a healthy way. Disclaimer. The information provided here is for general understanding and educational purposes only. It should not be treated as professional financial investment or legal advice. Every company's financial situation is different. So please consult a qualified financial advisor, accountant, or professional before making any decisions based on this analysis. Although care has been taken to explain things in simple language, there may be variations in real life situations. The user is responsible for using this information wisely and at their own discretion. Thank you very much for your patience. Request for like, subscribe, and share.